I think Airbnb is more than just merely offsetting employee stock-based compensation. Nice try, internet trolls. There was an excess amount of worry that Crocs was done for because of that purchase.
Okay, let's move on to the dumpster fire that is Arcadium Lithium. Hey everyone, welcome back to Chipstock Investor. It's hard to believe that it's already the middle of 2024. So, we're going to talk about our 2024 stock picks and review how they've been doing so far this year.
Maybe just to preface this update, we made these picks at the very end of December 2023. We put money on these companies or were added to our position in some of these companies. And we're not doing this update 6 months later because we're planning on selling any of them after 6 months. As you probably figured out, the vast majority of our adjustments to our portfolio are very small. When we purchase, plan is to hold for the long term. And if we have picked a losing stock, we like to give it at least a year or two before making a hard decision to pull the weed from the portfolio and reallocate the proceeds somewhere else. So why are we doing this update? Well, we do want to assess how the businesses we own are faring. And that's roughly every 6 months, with the exception, of course, being chip stocks, because, that's why all of you are here. There's a lot to learn in the technology hardware space and computing space. So with these non-chip stocks, about once or twice a year check-in seems about right for most of them. So let's talk about what we said we liked at the very end of December 2023 and where we're at today. All right, here is the performance of these non-chip stocks from highest performers at the top to the really ugly, terrible, awful loser, Arcadium Lithium, formerly Livent and Alchem, there at the bottom. Now, we weighted our purchases by market cap. So Amazon was our first and top purchase again in December. And in all of this AI infrastructure hype and craze, I think my biggest surprise here is that Amazon is merely a middle of the road performer at up only, in parentheses, 20% ish so far this year, and a couple of shoe stocks far and away leading the charge higher.
Yeah, I'm a bit surprised as well, Nick. You can see that Crocs is actually our biggest outperforming non-chip stock this year so far, up nearly 70%. And then on 56% this year. Pretty incredible growth for these two companies, two of my favorite shoe companies.
Okay, let's come back to the shoe companies because I know you've got more to say about Crocs and On Running. But let's start with Amazon. What happened? Why is it up roughly 20% this year, building off of a pretty impressive rebound in 2023 as well, reaching new all-time highs? Not really a surprise, as Amazon pretty clearly indicated and as they've delivered so far in the first quarter of 2024, massive increases to profitability.
In North America, you can see the operating income jumped all the way up to nearly $5 billion from 898 million last year at the same time last year. This is the 3 months ending in March of this year. And then for the international portion of the business, 903 million in positive territory now. It was negative same time last year. And then Amazon Web Services nearly doubled their operating income at $9.4 billion.
And this was the thesis. GAAP net income would begin to hit really incredible leverage for Amazon as they refocus not on all-out growth, but on flexing their operating model muscle, you could say. I think there's a lot more of this to come in the years ahead from Amazon.
Let's move on to our second pick. We'll talk about Salesforce and also about ServiceNow. Both of those companies are in the software industry, and Salesforce has taken a massive nosedive in the last few weeks.
Yeah, the year started off hot for Salesforce. Lots of optimism as CEO, co-founder Mark Benioff and his top team make this big pivot from, again, like Amazon and a lot of other big tech companies, from all-out growth to, hey, let's grow profit as quickly as possible. The problem, as we outlined a couple of weeks ago for Salesforce, is it looks like AI stuff in general is eating up corporate budgets and leaving a lot of top software as a service companies with maybe, let's say, leftovers in corporate budgets. So growth has definitely slowed down dramatically. We're looking at less than 10%. And then Benioff and management did slightly cut their outlook for GAAP operating margin by just 0.5%. So that sent shares back down to earth. We're still very optimistic about our long time holding in Salesforce. And you mentioned the alternative pick in ServiceNow, Kasey. That one's still pretty hot right now.
Yeah, ServiceNow has been driven up certainly by none other than AI. We're still happy with our pick in Salesforce. However, we'll see how the second half of the year turns out for it. If you missed our video on Airbnb just last week, make sure you go and check that out. But Airbnb was one of our top picks for 2024. An alternative was Booking Holding for this software tech platform industry. And the real story with Airbnb was profit margins and free cash flow.
And that's exactly how this has panned out. As we highlighted in the video that you mentioned a couple weeks ago, there was a big tax benefit Airbnb logged in 2023. We still haven't lapped that big benefit to GAAP net income. But in spite of that, Airbnb continues to ratchet up its GAAP net income in pretty impressive fashion. Again, we expect this to continue for the foreseeable future. But while that GAAP metric can be pretty noisy at this particular stage because of Airbnb still being a fairly young business, we think free cash flow continues to be the best metric to measure the company's operating margin expansion. And they continue to deliver on that front as well. 18% revenue growth in the first quarter of the year led to a 21% year-over-year increase in free cash flow.
Stock repurchases have been a big factor for Airbnb as well. You can see in the last quarter, they purchased $750 million worth of shares.
And we did have some comments about this, stating that, well, free cash flow getting turned into stock buybacks isn't that impressive. It's only offsetting stock-based compensation to employees. Sure, yeah, it is. In the last quarter, $295 million worth of employee stock-based comp, $750 million in stock repurchases. I think Airbnb is more than just merely offsetting employee stock-based compensation. Nice try, internet trolls.
Oh, that was aggressive. Now on to my favorites, the shoe companies, On Holding, On Running, ticker symbol ONON. Our chart here from our friends at FinChat, link in the description below for 15% off a membership. They have lots of charting tools that you might find useful in your analysis of businesses. One cool feature that they have specifically for a company like On, which is headquartered in Switzerland, you can change between US dollars and Swiss franc currency to see the effects of currency on the financials.
So we have it displayed here in US dollars, and you can see the nice consistent revenue growth. Company has remained pretty steady in the growth department since their IPO a few years ago. GAAP net income, or maybe I should say IFRS net income, because this is a Swiss company, not a US company. You can see some inconsistencies there. And as you just mentioned, Kasey, a lot of that has to do with currency exchange rates. Much of On Running's revenue is based in North America. So when they make a sale in US dollars, they have to convert that to Swiss francs. Now, after a really, really epic run up in the US dollar in 2022, along with Federal Reserve interest rate hikes, the Swiss franc has been gaining in value again since then. That has an outsized effect on ultimate net income. When the Swiss franc increases in value against the currency that On collects most of its revenue from, again, the US dollar, you can see the spikes in the Swiss franc roughly correlating to those dips in net income here on this chart. Ultimately, all of this is going to come out in the wash over the long term. This doesn't bother us too much, but it causes lots of fluctuations in the actual stock price. Okay, financial weirdness aside, On is expecting in currency neutral Swiss franc terms at least 30% growth again this year. That's a pretty high bar to clear, or is it?
It is a lofty goal, but it certainly seems like it's something that is attainable for this company. They've recently signed some new recruits to the label, including actress Zendaya. I don't know how to say it. I'm not that
It's
cool.
Zendaya.
I heard it was Zendaya. Are you sure?
No, I'm not sure. All I know is she is one of the lead roles in Dune.
Ultimately, we think that this will nab some more Gen Zers coming to the brand.
Yeah, that's right. The success of Dune seems to automatically equate to growth for On running.
That's what we're going with. Okay, let's talk about Crocs. In other entertainment news, I saw that Brooke Shields wore Crocs to an event recently.
Okay, I have no idea who that is either, but okay.
All right, Crocs was laughably cheap. Tell us more about that, Nick. Why was Crocs one of our top picks of 2024?
Yeah, it was laughably cheap. And even at this stage, it's probably much closer to fairly valued now. We have to account for the high burden of debt that Crocs took on to purchase the Hey Dude brand, quickly coming up on 2 years ago. And that acquisition, or maybe I should say growth of that acquisition, has soured a bit. Management is working through those issues. And that's basically why the stock came up. There was an excess amount of worry that Crocs was done for because of that purchase, trading for well under 10 times trailing 12-month earnings. The free cash flow yield was ridiculously high, well into the teens at the end of last year. So we bought more Crocs. And I also bought my first pair of Crocs as well. And I'm not as big a fan as Kasey, but they're pretty good. I'm going to say they're pretty good. I can understand why they're so popular now.
There has been some concern over specifically the acquisition and the integration of the Hey Dude brand into Crocs and the growth trajectory possibly slowing because of that. What do you think about that, Nick?
Yeah, what's been going on as of late is they've had to right size their distribution model for Hey Dude. They sort of flooded the market with them. Maybe a little bit of debate on whether that was an intentional move to increase brand awareness of Hey Dudes or if it was a misstep or maybe a combination of both. Whatever the case, though, it seems that the problem is getting fixed. Crocs or Hey Dude, I think we can safely assume is not going to be a high growth business anymore. We expect this fully to be a mid single digit revenue growth business over time. But again, with the stock being so cheap, it just seemed like a lob at the end of last year. And we're still very happy to hold on to this one. Depending on how management executes on some of these growing pains in the course of the next 6 months, we might consider buying more Croc stock. I think we'll have more to say about that before too long, huh?
I think so. Let's talk about Shift4 Payments.
Okay, so folks, you probably know Kasey's disdain for Block, formerly known as Square. You probably also know that at the end of last year, we decided to exit our longtime holding in PayPal. Visa and MasterCard are our core positions in digital payments / financial services infrastructure. We did want to add a new company to our small cap basket of stocks. Those are roughly 24 companies we own small positions in, and Shift4 was one of those that we started adding to late last year and added to again at the beginning of this year. And it seems that the stock price was getting bid up quite a bit on this expectation that Shift4 was going to get acquired.
Yes, it certainly appeared that way. And in the middle of March of this year, CEO Jared Isaacman said that the bids were not a sufficient value for the company. So they decided not to sell or merge the company, and they're going to continue on as a standalone business.
Yeah, and we're happy with that. This is not one that we bought on the expectation it would get acquired. We purchased it because it looked like a very reasonable value for a business that has consistently been able to grow and expand from its core, providing digital payment solutions for the hospitality industry. They've been growing quickly into larger venues like sports venues and stadiums, recently made a jump into Europe. So we're keen to see how execution of that expansion strategy goes. We still think this is a very reasonable stock right now. But again, part of our small cap portfolio. So this is a small position. And if we nibble more on this, it will remain a small position. This is just our MO with how we manage our portfolio with these small caps. If they want to be a bigger part of the portfolio, they earn it.
Okay, let's move on to the dumpster fire that is Arcadium Lithium. Arcadium Lithium is down nearly 51% year to date, back to basically all-time lows, just over $3 a share. And ultimately, this is why the lithium market price is also down to lows not seen since 2021. Is there any hope of this rebounding this year, Nick?
Absolutely. In our last video a couple months ago on Arcadium Lithium, as well as Albemarle, which we've owned for a bit longer, both companies outlined how they can actually remain profitable, even with some pretty lackluster lithium market prices this year. Unfortunately for Arcadium Lithium, the stock price is just completely tethered to the not so transparent, I might add here, not so transparent price of lithium. There's a lot of noise going on right now as the market tries to find some sort of bottom. And a lot of this drama has to do with the EV market. This lithium carbonate market price chart is from Trading Economics. And they note on their website regarding lithium prices that things like the recent European Union tariffs on Chinese electric vehicles, which set off a similar increase on tariffs in the US on Chinese electric vehicles, raising the duties up to 100%. So basically doubling the price of the car when it enters the US. A lot of worry here that demand for EVs will continue to slow down this year and hinder some sort of recovery in lithium demand. I think it's important to point out here that it's not just electric vehicles that are expected to, over the long term, increase demand of lithium. It's also hybrid vehicles as well. The batteries in a hybrid vehicle also much, much larger than that in a smartphone or a laptop battery, which is the traditional market for lithium ion batteries. So still a lot of long-term growth for lithium. Unfortunately for our stock pick in Arcadium, this one's going to take a lot more time to kind of flesh out its trajectory. It's been ugly. It's still ugly. And I think at this point, it's maybe safe to assume 2024 could just maybe not be a great year.
Sometimes that happens.
Maybe the Federal Reserve will lower interest rates this year and that'll bail us out. Not hoping and praying for that, though.
Not likely. So there's our top picks for 2024. Let's maybe focus on some of the companies that we've actually added to our portfolio that were not on this list. Airbnb, we've talked about already on this list. We have added to our position in that so far this year. But a couple of new ones for us, Celsius and AppLovin. And we've also added Netflix, which we have been kind of resistant to in the past. And then Berkshire Hathaway is one that we've had for many years.
Yeah, over on our Discord page, we've explained a bit more in depth on Celsius Holdings, why we finally pulled the trigger on that earlier this year after the recent stock price tank, again, after some probably overblown worries about them capturing more market share via their distribution deal with Pepsi that they signed a couple of years ago. We think this looks like a pretty decent time to nibble. AppLovin, we've actually done some videos on already. Check those out. And then, of course, Netflix. That was the replacement for Disney, which we finally got rid of at the beginning of this year as well. I said we tend to make small, gradual changes in our portfolio, but there have been some exceptions in the last year and a half or so as we've come out of the bear market. Pivoting from Disney to Netflix is one of them. Yeah, it was long overdue after more than a decade owning Disney, well over a decade, I should say, of owning Disney. Yeah.
It was tough to rip the Band-Aid off, but it was time.
Kasey ripped the Band-Aid off on that one.
I did.
And then Berkshire Hathaway, again, folks, everybody just completely obsessed with AI, and suddenly everyone's an expert in semiconductors. Some of the top names starting to look a little overheated. It's not to say that we think there's some sort of bubble ready to pop. That's absolutely not what we're saying. But sometimes the best buy is maybe something you've had in your portfolio for a long time already, and maybe just kind of has gotten temporarily forgotten. And so maybe Berkshire Hathaway is one of those stocks right now. Yeah, if you're looking for a fantastic portfolio anchor for the long term, this is a pretty good collection of especially industrial businesses that Berkshire owns outright in their portfolio of wholly owned subsidiaries. Of course, there's the big Apple stock bet in the stock side of their portfolio, but a fantastically run collection of industrials and energy companies at Berkshire Hathaway.
There you have it. There's our mid-year review for 2024. For our non-chip stocks, we're going to have a video coming out soon regarding our chip stock picks of 2024, our mid-year review for that. Make sure you hit the subscribe button. And if you're interested in more discussion on this, head over to our Discord channel via a Semiconductor Insider membership. It's only $5 a month. And we have been discussing all of these companies this entire time over on that Discord channel. It's a great value and helps you learn how to be a better investor. We'll see you again soon at Chip Stock Investor.